Hey, it's Rick and Mike, and we switched it up today, so hopefully you know who's who. Today, favorite topic of ours. We've done it before. Question from a client, though. Today we talk dividends. It is a little bit more sexy than that, though. Um, Video, I don't know, a year or two ago about how dividends work, what they are. We have some of that now, but what Dave's question specifically was, and we love questions from you guys, so if you have them, send them in. Dave's question was really more about an article he saw about, with rates being, bond rates and fixed income rates being so high as of, 2022. It's something from zero to, all-time, lifetime highs for me at least, in 22. So dividend stocks have kind of fallen out of favor and potentially getting second guessed on if they're a good investment or not. And we definitely drink the Kool-Aid, if you will, here on dividend stocks. Not for everything, but for some of it. They definitely have their place. So wanted to address Dave's question. Thank you for the question. If you guys have questions, send them in. We love to talk about them. Give us stuff to talk about. But Mike, what is, if I say, hey, dividend stocks have kind of lost their cool factor and, they're just not the way to go anymore. What say you on, are dividend stocks out of favor? Are they ever come back into favor?
Yeah, dividend stocks are sitting alone in the lunchroom right now, I guess. But different investing styles coming in and out of favor. And what's happening right now is income from bonds due to rising yields is now well in excess of what you can get from your typical stock. So that's a byproduct of rising interest rates. So a dividend, however, works different from an income stream than a bond. There's a couple different things to be aware of. One, the dividend, as long as it's qualified, is taxed at long-term capital gains rates. The income from a bond, unless it's a municipal bond, which is another topic, is going to be taxed at earned income rates. So there's differences in taxation. Also, a bond, the best case scenario is that we get the coupon for that bond, assuming no default. The yield that we start off with a bond portfolio, the PIMCO has shown that there's a 93% correlation to our starting yield and rate of return that we get on a bond portfolio over a 5-year time horizon. So it's very steady, boring. Whereas stocks can be increasing over time. Cooper, could you throw up the example we have today for Parker Hannifin? So full disclosure, Parker Hannifin is a stock that we actually invest in here at Heirloom Wealth Management. It's not only paid a dividend, but grown it on a per share basis every year for almost 70 years. So the big difference from an income standpoint beyond the taxation is that for stocks, at least the way that we try to invest in stocks, we've got the potential for an increasing income stream over time. Now that can be very fruitful over the long term. Cooper, you can throw up our next image. We've got a graphic that will illustrate this. Particularly if we can reinvest dividends either across the portfolio or back into the investment itself to compound growth over the period of time that we hold it, to increase growth over the long term. So this example, we're looking at two different investments. The blue investment, we're looking at paying a 3% dividend yield, relatively modest. The orange investment is paying a 6% current yield. It's more like a bond. In fact, investment grade bonds today are yielding about 6%. So pretty realistic. Now, if we own a stock, let's say that it can increase that dividend. There's no guarantee of this, but we'll talk more about how we approach this later. At a 10% rate per year, over time, if we reinvest that, we can actually outgrow the income stream that we would have had from bonds. So, in this example, if we took $1 million and put it in a stock portfolio that was yielding 3%, growing that dividend at 10% a year, in 25 years, that $1 million investment will be paying us $650,000 per year in dividends. Let me repeat that. That is a 65% return per year that you're getting on your initial investment 25 years later. It's just your compounding, taking the income to buy more shares. The income is growing. The share that you own are growing. So a little bit of a difference between stocks and bonds, why you might want one versus the other.
The dividends, in retirement, one thing really important thing, we talked about this before, but, if you have a $100 stock price and a dollar dividend, right? If the stock could go to 50 or even 25 or 10, and if the the fundamentals of the stock and the company are the thesis holds up. We're just in like a 2008 or, oh my God, COVID happened, things just dropping, no one's spared. But the stock is still good. Like, there's a buffer there because that yield just gets too attractive.
Mm-hmm.
And you're still getting the income that you were counting on before. So if you're a retiree and you're on fixed income, you've got income that is going to be there if we've done the right research on, dividend cushion. You just don't invest in every dividend stock. We'll get into that in a minute. But you've got your dollar coming from your one stock. And then it's buffered because it's such an attractive yield as it goes down that it'll come back up for those dividend hunters out there. And if the stock is growing, like Parker Hannifin was just showing, like at that much of an increase, your inflation hedge against your fixed income problem you typically or historically would have with bonds, like it's the 10% growth of your dividends. I mean, that's going to outpace inflation. So it's a pretty good spot to be. So I mean, we have not really soured on dividend stocks in general. I mean, now, why don't we invest in all dividend stocks?
Well, that's a good question. And one of the reasons we want to do this video is we got a couple questions over the last week on dividends. Why wouldn't we just buy the ones that pay the highest yield, right? Yield is the income per year that you're getting from the stock divided by the price you pay. So you could find stocks yielding north of 10%. And so you're getting a higher dividend yield, but there's often a reason for that. Maybe the business is in trouble, so the share prices come down. Fundamentally, they're not as sound, or their future growth prospects aren't as good. That's a reason why you might have a higher current dividend yield. It doesn't necessarily mean it's a more attractive investment. In fact, it can be a red flag. So if you have a particularly high yielding equity investment, there's a risk of what's called a dividend cut. They might not only stop paying the dividend that they had been before, but pay a substantially lower amount. Typically when that happens, you have the stock price decline along with the dividend cut. It's a double whammy. That's not good. We saw that.
As a board, I mean, you're like, you guys commit to a dividend, like you got to commit to a dividend because taking it back is like, ugh.
Yeah, that you could put that in the plus column for dividend-paying stock, is that it instills discipline into the management to continue to be able to pay that dividend. Because if they cut it, there's going to be trouble for the stock price. Investors do not like that. Now,
period of time when we look at an example for dividends that were getting paid out that probably shouldn't have been, like the very, very attractive yields from companies that probably shouldn't have been paying them out.
Well, one way that I would point, one time period that I would point to is the 2014, 2015 collapse in oil prices. You had a lot of energy related investments that were paying extremely attractive yields north of 10%. Well, they were also, from a capital structure standpoint, carrying a lot of debt. They had a high level of capital intensity and projects they had going on and investments that were being made. Well, when energy cratered, when the price of energy, oil and gas went through the floor, they weren't able to generate the same income streams, but they still had the debt payment obligations. So a lot of them cut their dividends, and we saw stock prices, decline in a way that they didn't quickly recover from.
Yeah.
So it can be unpredictable. That's why we use the dividend cushion methodology to avoid investments that might have a dividend cut.
So dividend cushion, for these that know, it is what it sounds like. It's how much of a cushion is there to continue to pay that dividend. So we're going to look at free cash flow. Are they financing the dividend? What they're doing with their R&D, that kind of thing. I mean, interesting enough. Now that you get R&D credits coming back here, curious what companies switch up to. But what else goes into a dividend cushion besides cash flow?
Well, this metric comes from one of our favorite research providers. It's termed the dividend cushion, and it's very simply, you look at the free cash flow that the business is going to generate. Free cash flow represents, for us shareholders, after all the investments are made to pay employees, cover the rent, and invest, make capital expenditures and future growth, what's left over for us as owners. We project that out over the next 5 years. So that's the first step. The second step is we look at the balance sheet. For a balance sheet, this is going to look at what kind of assets does the business have relative to liabilities. Particularly, what we try to find is what the cash and short-term marketable securities dollar amount is. We subtract out any long-term debt. If that's a positive number, it gets added to the 5-year free cash flow projection. If it's negative, it gets subtracted. That goes in the numerator. The denominator, we simply just project what we think 5 years worth of dividends are going to be for the stock. the higher the number, the safer the dividend, the less likely a dividend cut, and all else equal, the more likely the dividend increases are going to be.
Yep.
So for us, that's important that we be forward-looking. There are other methodologies such as, hey, we're going to own a portfolio of dividend aristocrats, which is looking at investing in businesses that have paid and grown a dividend over a certain time frame, 20 plus years, let's say. I think that's more driving in the rear view mirror, right? We're looking at what's happened in the past and hoping that continues in the future. Not always the best way to invest. Other ways to look at it would be, what is the dividend payout ratio, which looks at, here's the net income for the business, this is the percentage that they're paying out in dividends. The higher they're paying out in dividends of earnings, the more things that could go wrong. If earnings decline, they might not be able to continue paying that dividend, might see a dividend cut, or at best, a stagnant, not increasing dividend, which we don't like.
Yeah. So we are in a situation where we might be seeing a Fed rate cut and fixed income not paying as much as it has. Are dividends cool again? Do they find people to sit at the lunch table with again? I mean, are they suddenly in vogue again?
They are. The dividends coming
I feel
in
like we
out
just
of
had this
favor.
conversation about fixed income too. I feel like fixed income was the devil for a while, and now it's like sexy.
Yeah, good point. That 100% true. Now, for a fixed income investment, one risk that you have that you've got to consider is called reinvestment risk. If interest rates go lower and you've got a bond portfolio that's maturing, you're going to reinvest at future interest rates. If they're lower, you're going to get lower income. So you might have it'd be very rare in that example that we looked at earlier where you've got a steady 6% income stream that never goes up or down. But I think, if you look at the consensus market forecast, we're looking at potentially lower interest rates in the next 12 months. So that does pose reinvestment risk for stocks. At least the way that we try to invest in them, there's no guarantee. We look for rising income streams. So, when you think about that, it really just comes down to what are you looking for? Do you want higher current income, attractive current income with more growth? There's really no right or wrong answer, but for us, it just comes down to combining these two different asset classes in conjunction with maybe alternative investments, which is how we try to approach it, to have different sources of return. And we measure what's called total return, which is capital appreciation and income as the ultimate driver for what the portfolio value is going to do.
Stay tuned. Dividends may have a sexy comeback here. We'll find out. I would not underestimate the amount of money you can make from a dividend. I mean, these examples seem extreme, but Steve Ballmer, ex-CEO, I guess number probably 3 employee at Microsoft, he gives away. Steve Ballmer also owns the LA Clippers now. He gives away to his foundation $1 billion a year, which sounds insane, but he gets, just from Microsoft, over $1 billion a year. Side note, if you don't know who Steve Ballmer is, Cooper, I don't know if we have that, but put in the hyperlink of them dancing. It's the funniest
When
thing.
did the Windows 95 launch? We'll put it in the notes.
Bunch of dudes that should not be dancing are dancing. But
Don't go
anyway,
watch it now. Let us.
Although if I had $1 billion in dividends coming my way, I'd probably be dancing like that too. So
Fair enough.
You can make a lot of money on dividends if the company you're investing in is quality. Microsoft turned out to be a good one. Yeah,
Been
don't
one of our
don't
top
sleep
holdings
on,
for over a decade now.
That is true. Wow, yeah. So don't sleep on dividends. Dave, thank you for the question. If you guys have a question, please let us know and give us some topics to talk about. And we will see you soon. Thanks.